Today, my guest is Bernard Reisz. He is a CPA, CPCU, ARM, and an ACI. We'll drill down into those in just a minute if you don't know what those are. We're going to talk with him about self-directed IRAs and how you can use your IRA to improve your returns. But first, a quick reminder, if you like the show, please let us know. We'd love to hear from you. You can like, share, and subscribe. And also, if you'd like to see how handsome our guests are, you can check out our YouTube channel and they under Commercial Real Estate Pro Network. Oops. All right. With that, I want to welcome Bernard to CREPN Radio. Bernard, welcome.
Hello, Darren. Great to be on with you, and thank you so much for having me.
Yeah, I'm really looking forward to talking with you about the Checkbook IRA. But before we do, if you could give the audience and myself a little bit about your background, and we'll go from there.
Yeah, be glad to. I'm a CPA with a focus on several areas of accounting and taxation. Have experience working with a broad array of taxpayers and companies, either on the accounting and due diligence side, as well as the financial planning side of things. And one of the things that we've noticed throughout consistently is that there are certain areas of financial planning that are not adequately emphasized. And those are being that everybody has their own incentives and what to present, be it your accountant, your financial advisor, stockbroker. Everybody's got a unique angle, and there's a need to present some of those things that are very powerful tools that tend to fall between the cracks because nobody's incentivized to present them. And that has brought us to the checkbook retirement accounts.
Yeah, no, it's funny you say that because it's so true that when you peel away and find what the person's objective is that you're speaking with, or whoever you're providing the service, you typically find that, and maybe it's not all selfish, just a limitation on what they have available in their platform and that. But I've yet to find one that's willing to educate me about all the other flavors or options out there, and make that available. So I'm excited to talk with you more about this. I mentioned in the intro there the other designations you have. Just so we cover that, I recognize a couple of them as insurance. Can you share with us the other ones?
Yeah, absolutely. So the CPA is widely recognized throughout the world. The CPCU, that's Chartered Property Casualty Underwriter. ARM is Associate in Risk Management. And ACI is Associate in Captive Insurance. So those are all risk management designations. CPCU aims to be the CPA of risk management. And ACI focuses on captive insurance, which is a very exciting, interesting area of risk planning and tax strategy. So being that this came into play as part of tax strategy for some of our clients, we decided we have to become experts in the subject and earned all those designations.
No, that's great. And I think that, or I applaud you on that, because I think that is one thing that I think is missing sometimes, is that the people understand there's a need out there, but don't fully understand how it integrates with the need and, the options and whatever degree of safety or all the inner workings there. So that's great. Well, let's talk a little bit about, or not a little bit. I want to learn about the concept of a checkbook IRA. Myself, and I would imagine the majority of the listeners, if they are a W-2 employee or have ever been employed as a W-2 employee, the concept of an IRA, or excuse me, not an IRA, it's probably at that point a 401k, and the IRA being more if you're self-employed. Have I got that much right?
Yeah, absolutely. 401ks are for businesses. And what we're going to focus on today is actually to shatter some of those notions. So self-employed individual can have a 401k, and they're the best candidates for the checkbook 401k. So the IRA is more for folks that don't have self-employment income, where somebody has self-employment income, they can actually have their own 401k. I think to map out the best approach to today, is provide a high-level overview of what we'd like to cover and provide a foundation and then get through it and provide lots of great information.
Now, if you're willing to take the controls and be the pilot, let's do this. I'd love to hear this.
Okay, let's do it. I guess it's good to have a brief introduction to IRAs, 401ks overall from a tax and accounting perspective, then talk about what's unique in the checkbook space, and to wrap it up with tax planning, tax strategy, especially in view of a tax reform. So this is a really, really great subject this time of the year, because for those that want to set up a checkbook 401k and get potentially $50,000 to $120,000 in tax deductions, they've got to get this set up before year end. So this is a great topic, and I'd like to bring all those together, the financial planning, the tax planning, and how it integrates with today's tax reform.
Got it. All right. Well, let's start with the concept, the 401k, the IRA there, and build from there.
So the key, it's helpful to remember that IRA stands for Individual Retirement Arrangement or Individual Retirement Account. So IRAs are tied to individuals. And many people may be familiar with traditional IRAs and Roth IRAs. A traditional IRA is a type of account to which you put money into in exchange for a tax deduction. So say you put $5,500 into a traditional IRA, that gets removed from your income in that year. It doesn't show up as income, and you have immediate tax savings that correspond to your marginal income tax rate. So suppose your combined state and federal income tax rate is 40%. So if you put $5,500 into an IRA, you'd be saving 40% of that on your taxes. You'd be reducing your tax payout to the IRS by 40% of $5,500.
Okay.
That's one component of it, getting the tax deduction. Once the money is in there and it's invested, it grows tax deferred. So you put the money into an asset, the asset appreciates, or the asset throws off dividends, interest, rental payments. There's income. There is no tax on that income. So the incredible power of that is the compounding that you can have over 10, 20, 30, 40, 50 years, depending on when you get that set up. So having decades of tax-free compounding is extremely powerful. There's a remark attributed to Albert Einstein that compound interest is the eighth wonder of the world. Those that understand it earn it. Those that don't pay it.
Right.
Have you heard that?
Yeah. No, that's a good one.
So we don't know whether he said it, but the concept is true. Getting the benefit of having that grow without the tax drag each year over time. I've got a spreadsheet that graphs it out and it accelerates over time. So 20, 30 years in, investing without the drag of the taxes, you can be looking at a portfolio that's worth many, many, many multiples of what you have with including the tax drag.
Right. Okay, so we've basically established it's a tax or an income deduction up front. The money you invest in then grows tax deferred, and you're getting the benefit of that additional amount instead of a lesser amount having paid the tax, right? And that's that deferral concept, right?
That's it, exactly. So the full amount, you get the full $5,500, and you can do that each year. But with the traditional IRA, when the money is withdrawn, it's subject to tax as ordinary income. So it'll grow tax deferred for all those years, but when it does come out, it comes out as ordinary income. That's the traditional IRA.
Right.
And that's contrasted with the Roth IRA, in which you receive no current tax deduction, but the Roth IRA remains tax-free forever after. So it's not tax deferred. There's no upfront income tax deduction, but the earnings are never, ever, ever taxed. So it's good to think about when you would choose one or the other to illustrate the different concepts.
Yeah, and that's even a little more powerful than the worrying about capital gains or anything like that. If you have no tax, that's you've taken the tax out of the conversation there. So that's good.
Yeah. And the things to think about, and there are a lot of different variables to think about when choosing one or the other. But one key thing to think about is, what kind of returns may you get on this investment? So, for example, Peter Levchin, Max Levchin, Peter Thiel, and Mitt Romney are all reported to have IRAs that are worth hundreds of millions of dollars. So they invested in companies at the startup phases where they paid pennies for shares of stock that today are worth hundreds of millions of dollars. On that kind of return, you want to have it in a Roth because you're not going to pay tax on all that hundreds of millions of dollars of upside. If it's more of an investment where the upside is not that high, then a traditional may be something to consider.
Okay, so we basically in the distinction there between the IRA, the 401k, and the Roth.
So
right?
First, let's keep it just to all these concepts will be at play in the 401k.
Okay.
But so there's Roth and IRA and traditional IRA. Then we'll take the concepts over to the 401k. So
Okay.
it's really about the contrast between traditional and Roth, tax deferred versus tax free.
Right. Okay. So, and like you said, if you have some investment that really goes nuts and grows significantly, if you got in with in a Roth with after tax dollars and it grew tax free, that's the home run, right?
That's unbelievable. And I'll tell you one area that we see it is that folks recently, many people cryptocurrency has attracted lots of attention. So we don't encourage people to put their IRAs in cryptocurrency, but we have helped countless people do so. And those that are doing that see at least a possibility of cryptocurrencies being worth, ultimately perhaps displacing fiat currency and being worth so much more than they are today. So for those people, Roth is very attractive because they think whatever they're putting it in today, it's going to be worth so much more in 5, 10, 20, 30 years that it's worthwhile. We have people that are convinced of that, and we have some people that view it as speculative, and they think, let's put some of my money into a Roth IRA or Roth 401k with cryptocurrency. And this way I can capture that possible upside tax-free.
Got it. Okay. So how do we get from the account to, and I assume the checkbook portion is where we get control, because up to what we've talked about at this point, I'm assuming you're dealing with a broker or broker dealer or somebody else is basically making the investments for you based on whether it be a menu of options if you're dealing with your employer, or whatever they have available to them, if there's some in-house funds or et cetera. Am I right on that?
So yeah, it's more about how people generally get introduced to these concepts. Okay. It's most people get introduced to it through a financial advisor, but really the concepts are tax concepts. So Congress created IRAs and 401ks to incentivize us to save for the future. I mean, we should know better than to rely on Social Security, and Congress certainly knows that we can't rely on Social Security for our retirement. So Congress created these accounts with the tax advantages to incentivize us to put money aside. Congress has said very little about how these accounts can or should be invested, and Congress generally doesn't want to say anything about that. They want to be economically neutral. They give us the incentives and then rely on us to make the wisest choices and be stewards of our funds. So these accounts there are very few restrictions on what they can be invested in. The only restrictions for IRAs are life insurance and collectibles. So collectibles means alcohol, rugs, fine art, certain precious metals and coins. Other than that, everything is fair game for an IRA and a 401k. So there's what we call kind of the vehicle, the channel, which is the IRA. It's just a type of tax advantage structure. But what you put inside it, the actual assets and investments, that's from the perspective of Congress and the IRS, That's up to you. You can put whatever you want in there. Real estate, tax liens, timber, restaurants, websites, cattle, perhaps cannabis investments, cryptocurrency, life settlements, merchant cash advance. If you can imagine it, you can put it into an IRA or 401k. But the question is, how do you do so? We're accustomed to thinking, hey, I need an IRA. I contact my financial advisor, or I go online and I look for Schwab or Fidelity, Vanguard, and I set up an account. Well, you don't have to get an IRA that way. That definitely is a way to do it. And if all you want to invest in is mutual funds, stocks, and bonds, that's a great way to do it. If you're looking for more flexibility, then you're going to have to take an alternate route, which most people are not even aware of is available. And so for now, for the moment, we'll talk about IRAs. 401ks don't need a custodian. We'll change gears once we wrap up the IRA side. So the IRA must have a custodian. It's in the code. So there are self-directed IRA custodians that allow investment in alternative assets. So in contrast to Schwab, these folks do not give you an IRA account for free because they provide no investments. You move the funds over there, you tell them, hey, I want to invest in this piece of real estate. You send them all the paperwork, and they send the money out to the closing, and the real estate gets titled in the name of your IRA, and your IRA owns the real estate. The rental payments come in tax-free, and that's how the investment can go. Well,
when you say tax-free, I guess that's still inside either one of those. It's
exactly, yeah, that's exactly it.
Yeah, it's staying inside the vehicle, right?
That's exactly it. So you can't use, the key thing you've got to be aware of is, just like when you've got an IRA at a brokerage account, you can't use that money. It's strictly for investment. Within a self-directed structure, it's strictly for investment as well. And all the investment returns flow right back into that retirement account so they can, keep growing tax advantaged. But what we implement in the IRA space is checkbook IRAs. With the self-directed IRA custodians, and they've got a different revenue model, so they're looking to make revenue off administering investments. And being that it's more of a unique space, some of them charge asset-based fees. So based on the value of the asset, you'll be paying a percentage of that to the custodian for holding the asset for you. Each time you have a transaction, they may charge you a transaction fee to process it. And processing takes time. So if you've got a closing, which oftentimes is a quick closing, if you've got it's an REO and you got to move quickly, you'll encounter expedite fees. So it can be an expensive proposition to use a self-directed IRA custodian. In contrast, you used to have your IRA at Vanguard, low cost, low fee. This looks expensive. So in all fairness, of course, there's no such thing as free. So when you're at Vanguard, there are fees. They're just not visible to you. But over with the self-directed space, you see the fees, and they can get to be kind of sizable. And it can also be cumbersome to invest, because every time you've got a deal, you've got to do all the paperwork yourself, find the deal, do everything as you normally would. Then on top of that, send all the paperwork to the custodian, title it, to have everything retitled in the name of the IRA, and you incur all those fees. So it can be cumbersome to invest. So in order to deal with that and simplify, streamline things, make it flexible and cost efficient, what we focus on is giving people the money in a bank account. Instead of having the custodian hold the money, our clients actually get the money in a bank account that they control. They can write checks, wire, ACH, and completely disintermediate. No need to deal with the custodian when you've got that real estate investment. Any questions about that?
Yeah, no, I just want to make sure we don't run too fast on this. So obviously, if you've got a custodian involved, they're going to kind of watch the steps and make sure you're doing. I would assume that part of what they get the fee is to make sure you're not doing something you can't do, or that would jeopardize your the tax advantage of the account. So now, if I understand right, so I go set up a checkbook IRA, basically I've got a checking account with my IRA name on it. I've got the ability to write checks, and I assume when you mean write checks, it's to write to an investment. I mean, there's prohibited transactions, and we don't want to get into that. Is that essentially the ability? I mean, it's not like you can go buy a new car or something. Treat yourself. You're still. It's still the investment. It's still the vehicle. It's just now it's in a checkbook, and you can be more in control of directing it. Am I understanding that right?
Yeah, that you hit the nail on the head. I'll give a little more outline to the structure, but essentially by moving the money to a bank account, all the rules, IRA rules still apply. So it's about making it really inexpensive, very cost effective, and very flexible and giving you control. But all the IRA rules apply. So with the custodians very clearly and explicitly emphasize that they're not giving any tax compliance or investment advice. But it is true that with the custodian holding the funds, it's harder, to inadvertently engage in a prohibited transaction. Whereas if you've got the money in a bank account, there is the possibility that you can inadvertently engage in a prohibited transaction. But whether you hold the money at a custodian or you have the money in a bank account, it's the account owner and the investor that's got to be aware of the prohibited transaction rules, because we've seen all sorts of stuff go on with custodians that violate the rules, and we have many clients that we educate about the prohibited transaction rules. And as long as you stay investment focused, you should be good. The structure, the way it has to be done, being that the funds have to be held by a custodian in an IRA space, what we do is set up a private company within the IRA. So just like you can take your IRA and invest it in Apple and Amazon and Microsoft, and you can also invest it in a non-publicly traded company that's a startup, private equity. Those are not usually available in a brokerage account, but they're definitely doable. So we create a similar structure, and we have the IRA holder, the IRA account owner, manage that company. So they're designated as the manager of that company. It's structured so that it's compliant and the custodian will fund it. From the custodian's perspective, it's like a private equity investment. You're making an investment in a company, and that's the asset that the IRA holds. Now that company gets a bank account, which can be directed by the manager of the company and directed into any asset. And so all the real estate, the cryptocurrency, the tax liens, that goes on within the company. So we've got custodians that we work with, being that they're having very little interaction with the investments. They're really doing close to nothing on an annual basis. They're ready to give our clients a rock bottom pricing for having the IRA account with them. There are no transaction fees because the client, the IRA owner, manages all the transactions. So you get great control, simplified paperwork, because when you do a deal, it's just in the name of the LLC, and everybody knows how to do business with an LLC. And the fees are really, really low. So you get lots of advantages, but the prohibited transaction rules, of course, apply.
Okay, let me just make sure I understood the chain of command here. So the IRA, the self-directed IRA, then owns this LLC. Is that correct?
That's exactly it. It's structured so that the IRA is the owner of the company. With the IRA as the owner of the company, the IRA transfers its assets to the company, and then that company is managed by the IRA account holder. Or it can be anybody else, but that's the most common scenario.
Okay. All right. So let me ask you this. I mean, the fees that are involved with a traditional IRA with a custodian, would it be out of hand for the manager of the LLC to get a fee? I mean, would that be a prohibited?
Well, if the manager, that's a great question, yes. And if the manager, the one that's managing the LLC, is the IRA account holder or some other disqualified person, they should not get any compensation. They certainly should not get any compensation. We always, when it comes to prohibited transactions, we always want to err on the side of caution.
No, makes sense there. Okay. No, I get the structure now. So let's talk a little bit about the investment options, specifically with real estate. I think that's kind of the majority of the listeners are probably interested in that. So we've set up the Checkbook IRA. We've got the LLC, which is owned by the IRA. We want to make an investment in a let's do a couple different options here. Let's say one is just a piece of real estate that's just going to be my LLC owning, period. Are there any concerns with that?
Yeah, there are a couple of things, and before we get anybody signed up, we make sure to point these out ahead of time to make sure that what they're trying to achieve can be achieved within the IRA. And some of these rules that we'll discuss have to be contrasted with the 401k that have some more liberal and more advantageous and attractive, beyond what the IRA offers. So when the IRA goes to buy real estate, if it's going to be an all cash deal, it's really simple. The key thing to remember is that the IRA or the LLC is the one that's doing the investing. Everything is done in the name of the LLC, and it looks very much like a regular deal. Where it gets to be a little different than what people may expect is when you using leverage. So it comes as a surprise to many that the IRA or 401k can use leverage. So if you've got $200,000 in your IRA and you'd like to buy a multiplex for $400,000, your IRA can borrow the money. You're not restricted to using only $200,000 for investing. So that's a great feature, because when we talk about real estate, leverage is a key component of maximizing your returns within real estate. However, people that are buying smaller properties, they're twoplex, threeplex, fourplex, or your single family rental, are accustomed to having loans where that they personally guarantee it. The lenders usually, if you want to get advantageous financing, you want to put down your 25%, you get a personal guarantee, and you get to finance up to 80% of it. Within the IRA, being that you're not supposed to be part of the transaction as a disqualified person, the IRA account owner may not personally guarantee any loan. So any loan taken by the IRA has to be non-recourse to the IRA owner, and it can be recourse to anybody that's not disqualified. But in most scenarios, we're looking at a non-recourse loan. So with a non-recourse loan, you're going to have a higher down payment. Your equity portion is going to be higher. The interest payment may be somewhat higher, and you may be expected to have some additional reserves. Is that making sense?
Yeah. No, and I think if I follow that logic, that's why the syndication model, if I understand right, allows for self-directed IRAs to invest in a syndication model as a limited partner, because you're not, you're not signing. It's a non-recourse loan typically. Am I tracking right on that?
That's great. And because when you look at syndicated deals, you're usually looking at the loan is non-recourse generally to anybody. Right. It's going to be a commercial loan, and it's really about the subject property. So that would mirror the kind of equity percentage is closer to what you would see on any non-recourse deal. Because on a non-recourse deal, the risk to the investor is so much lower, and the risk to the buyer is that much higher, because they're limited. They can only go after that property itself. It's not based on your credit score. It's not based on your assets. So when the IRA owner invests in real estate using a non-recourse loan, their risk is really limited. It's the property itself. The bank or the lender, maybe a private lender, maybe a commercial, it can be any kind of lender. Their risk is much higher because they have to look at that property itself.
Got it. Okay, so essentially, if I gather the sum of the leverage issue is that it cannot be recourse. Are there any other?
Yes, you
Are there
got it.
any other issues with the
Yes.
leverage? Okay.
And the other component is, I wouldn't call it an issue, but it's something that you've got to be aware of, is unrelated debt financed income. And there are certain cases where even not tax exempt entities can be liable for tax. And one of those is when they borrow money. The 401k is exempt from this for real estate, which is an incredible feature. But in an IRA, you've got that. So say you put down the $200,000 and you borrow $200,000. So 50% of those profits are really profits that Congress never intended for you to have in an IRA. Congress says you can put $5,500 a year, $6,500 if you're a little older, into an IRA. But here your IRA went out and it borrowed money to do the rest of the deal. So that money was never, you've kind of found an end run around limitations in what you can put into IRAs and 401ks. So to the extent that you're using borrowed funds, the income is taxable. So there's the potential to have taxable liability even within an IRA. How does that sound?
Yeah, no, and is this what is referred to as a boot?
So boot is the kind of thing you would in a 1031 you'd find about you'd come across a boot.
Okay.
So it's a different concept than boot.
Okay, let's back up and walk through the tax liability. So the example you've laid out here, we've got $200,000 in equity from the IRA. We buy a $400,000 property, we get a $200,000 non-recourse loan. The benefits, the gain, is what we're talking about, the tax liability. Am I right?
Yes,
So
that's right.
At the point of sale, so we're 5 years in the future, 10 years in the future, the 400 is now 800, just to keep it simple.
Mm-hmm.
How is that going to be treated?
Okay, so it's relevant both, potentially it's relevant throughout the 8 years. So like any rental property, if there's rental income, and we're talking about net income, there's the potential for tax. So in the early years of an investment, a real estate investment is usually no income because you have the benefit of the property tax, the interest, the depreciation. So all the deductions that you always have in real estate, those are there to reduce the income and to show no income or even a loss in the early years, that paper loss. So your cash on cash return may be great, but you're showing a paper loss. In addition, there is a specific deduction of $1,000. So even if there's a potential for a tax liability, if the taxable portion of the income is below $1,000, the whole thing doesn't apply. But it's also at some point, you're 3, 4, 5, 6 years into the investment, and now you're showing income for paper purposes. At that point, there's a potential for tax liability and it's based on the percentage, the portion of leverage that's used, and it's calculated based on the outstanding debt. So if it was an amortizing loan at 8 years in, you may have paid off a substantial portion of that. And at that point, based on the percentage of debt to your basis in the property, the income would be taxable. And the calculation itself is probably more than we should talk about on a podcast. But the key thing is to realize is it's only the portion of income that we would allocate to the debt that is taxable.
So help me just understand this real quick. So the example we talked about, we've got a $200,000 loan. We've been paying on it for say 8 years. That's roughly what little less than or a little more than a quarter of the loan term if you did a 30-year loan. Mm-hmm. So just for simple, I know this is not an amortization schedule, but let's just say you've paid down a quarter of the loan. So essentially your balance is $100,500. All right. Mm-hmm. Can you explain for me exactly what you were talking about as far as how the loan, the tax liability there?
So you would calculate something that's called your debt to basis ratio. Okay. And based on that, a percentage would be determined that would be applied to the net rental income, and that portion of the rental income would be taxable as UDFI, unrelated debt financed income. So you'd be looking for the two numbers that you have to think about is the amount of debt in the property and your basis and your adjusted basis in the property. So it's, the calculations going in 8 years can be a little convoluted, and it's understanding basis.
Right.
But suppose, using the first year as an example, where it's simpler, suppose you had a great property and it's cash flowing so much that even in year one, you've got you have taxable income. You can't even show paper loss. And something in real estate that I feel is people get so excited about losses. The tax benefits of real estate are amazing. But of course, if you can have a property that can cash flow, that even after all those deductions, you're still showing profit, that's better than a loss. People get carried away with the losses.
Right.
It's better not to, be better off even without those losses. So in the first year, you put in 200 and you borrow 200. A approximation of what you would owe is 50% of the profit would be taxable.
Okay, based on your basis. So as you pay down that loan, would your basis increase then? As you
pay down the loan, the debt goes down. Right. Over time, the basis goes down somewhat as well, because you're having that depreciation. So your basis also goes down, also decreases gradually over time. So it really depends how those two numbers are moving in relation to one another.
Okay, so you're still getting the benefit of the depreciation there.
Oh yeah, absolutely. So you have all those regular offsets. But the key thing to be aware of is that portion of the income is kind of free money almost, because it's the return on your leverage. It's
right.
not the return on your IRA. So the return on the leverage portion is money that that's the free return. Your actual IRA return, it remains tax-free. So whatever you put in there as the equity portion from your IRA, that maintains all the tax benefits. There's no taxable impact whatsoever.
Okay. I get the concept. Is that an easy thing to track, or is it a difficult exercise? I mean, when you're doing your taxes on that kind of thing, I mean, normally I would think of, you show your income less all your expenses, you get to a number, and then that number, follows through on your tax schedule. And is there another calculation?
A key component to this is it's got nothing to do with the personal tax return.
Okay, so it's all inside still stays inside the.
Yes.
Okay, gotcha.
And it'd be amazing what we get. We have people come to us and say, my accountant says he's not doing my tax return this year because I've got real estate in my IRA and he doesn't know anything about UDFI. And we tell them it's got nothing to do with your 1040. If there's UDFI in your IRA, that's completely independent. You can go back to your accountant and tell him he can do your tax return because this is completely independent of it's the taxes within the IRA, and it's a separate filing.
Okay, so then, there you go. And then thank you for clearing that up. So the IRA has its own tax return now, and it has one of the checks that you'll be writing is to the IRS for the tax.
That's exactly it. If there's a tax, it goes to. It's got to be. And in fact, you may not pay it with your personal funds. It's the liability of the IRA to be paid by the IRA. So to pay it yourself would be paying an IRA liability with your personal funds, which should not be done.
Gotcha. All right. Well, I appreciate you taking me through that. All right. So we've established that you can do the real estate in the IRA. You set up the LLC. The LLC purchases the property. You get the loan in the name of the LLC. It's got to be non-recourse, and then the LLC owns the property, receives the rent, pays the taxes. Am I missing something?
Yeah, no, that's really it. And another benefit it's worth mentioning of having this structure is asset protection. We have everybody that owns real estate uses LLCs to one extent or another. You know, we're not going to get involved in how much property or how much equity you should have in any particular LLC. Should you have separate LLCs for each property, or put multiple properties, and how to, you know, actually structure that. But we all use LLCs for asset protection, and the same applies within an IRA. If your IRA, and for two reasons, if your IRA is going to have multiple properties, you'll want them to be segregated from one another. Your IRA may hold multiple assets, and some of it may be real estate, some of it may be, you know, assets of a different sort, and you don't want any liability to spill over from one to the other. So using the checkbook IRA structure enables asset protection. And another feature of it, which is a little more nuanced, but to a certain extent, it may protect any liability from an IRA spilling over to the personal side. If there's liability within an IRA, there is potential for some of that to spill over to personal liability, and using an LLC can mitigate that, and vice versa. So all the reasons why real estate investors use LLCs apply to IRAs, just as they would to their, you know, the real estate investments that they hold personally.
Got it. Hey, I want to ask you another question on the investment, the real estate there. So we've got the property. We've had it for a number of years. We've paid taxes based on, we've got more income than expense, or I should say, not we. The IRA has complied as it needs to with the IRS. We get to a point where we want to sell. Okay, we've got this gain. How's the gain treated?
So if no leverage, then again, it's all completely tax-free. If there was leverage used, then capital gains rates apply. So it would be very similar. And again, it's going to be based on that ratio of debt, of debt to basis. And a strategy that we advise people to use is pay off the debt before selling. And when you pay off the debt and it's been debt-free for 12 months, then the tax does not apply. So if you think you're looking to sell, it may be worthwhile to pay the debt off, and this way no UDFI tax will apply at the time that it's sold. If the UDFI does apply, it will be at the capital gains rate.
Okay, so let me just make sure I got that right. So you have this property we've been talking about, the $400,000 you bought it for. You had a $200,000 note. You had your $200,000 equity in there. You've kept it long enough to where the note's been extinguished, and now you go to sell. And let's just say, for example, it sells for $800,000. So you got a $200,000 or $400,000 doubled. Okay, yes. The asset doubled. And did I hear you that there's no capital gains tax on that because now there's no debt?
So Congress doesn't want you to pay down the debt and sell it the next day to avoid the tax. So there's like 12-month look back. But if the asset's been debt-free for 12 months, no tax whatsoever.
Wow. And does this work both ways? If you're in a Roth or a traditional? I mean, we've been talking about the checkbook IRA. If you had a checkbook Roth or checkbook Roth IRA.
Yeah.
Are you subject to the tax there?
Yes, and that's an excellent question, and it's great for us to bring that up because we've had people call us and say, I want it to be tax-free. I don't want to have UBIT. I don't want UDFI, so I'm going to do my investment in a Roth. Whether or not you do Roth or traditional, the UDFI applies the same. Because you've got to view this tax as kind of its own tax regime, and it's independent of the regular income tax structure. So this would apply the same way to traditional or Roth.
Gotcha. So if you had a group of investors that came together, whether it be joint venture, syndication, or however, but they did it without leverage, and the property increased in value, would that void any of that UDFI?
Absolutely. If it's a cash only deal, no UDFI, none of this applies. It is completely and totally free of income tax and UDFI tax.
Got it. That's a neat little trick. I mean, assuming you're able to do that,
Yeah.
pay that off before you sell. Um, so that's great.
And I guess one of the things it's good to, within real estate, there are so many ways to invest in real estate. And obviously, if somebody is a debt investor, none of this applies. And for somebody that's looking to have multiple streams of real estate based income, and say they're looking to do some private hard money lending as well as equity investing. So doing the hard money lending within the IRA is one of the most strategic moves they can make. Because hard money lending and private lending, that can generate really high returns, and it has no tax shield. If somebody does that in his own name, that's ordinary income. They're going to be paying, on that 10 to 20% return that they're getting, they're going to be paying their ordinary income tax rate. But if they have their IRA, their checkbook IRA, act as the lender, that's completely tax-free. There's no UDFI because they're not the equity, they're the debt. So something that we strongly encourage people to do, to think about, is using their IRA for their private lending investments, because it really benefits. It has none of this UDFI, and it needs the tax protection more so than any other investment.
That's a great tip there, because just to think about that, because I think so many times the investors that I'm normally talking with are more aligned with getting into an asset and controlling that asset. But what you just said there is, if you go into the debt side of things and you're the lender, you've got none of these issues that we've been talking about as far as the if I understood right, you've eliminated all the UDFI issues. Basic, and you're not. I mean, at that point, you're just basically, the income comes into the IRA. When it's paid off, I mean, you get the return. Am I missing something there?
That's exactly it. No, it's really that simple. And this is very common because, the people that investment sponsors in real estate, so they're usually going to finance a portion of it, and they're looking to raise money from investors for their equity portion. And without getting into the nuances, the lenders, the bank, if it's Fannie, Freddie, or a bank, what they've got to say about this, just talking from a tax perspective, if the investment sponsor, the syndicator, rather than taking that money for the equity portion, as a limited partner, they say, hey, give us the money, we'll do the investment, we're going to own it, and you just give us a loan. This way, and we'll give you a fixed return, whatever that's going to be. Then this is completely sidestepped. And
so let me ask you, going back to the guaranteed, or the what were we talking about that? Where the
non-recourse.
Yeah, non-recourse. Yeah. So if I am putting a deal together and I'm approaching IRA, people with self-directed IRAs for a loan, and they agree, are they limited again in that if I go get another loan? Well, I guess if it's not my IRA, it probably doesn't matter, because it's, as long as they're not signing on the loan, they're not guaranteeing the loan, then would it matter?
Right. You can personally guarantee a loan to an IRA. It's when the IRA takes a loan that the owner of the IRA shouldn't guarantee the liability of the IRA. But what you're outlining is a liability to the IRA. The IRA can secure it in any way it'd like. The IRA is going to be the lender. The IRA, or in this case, our checkbook IRA owner, they set terms. How much security do they need? What's the interest rate? How much risk are they comfortable with? What kind of guarantees do they want? That's all negotiable, and obviously the IRA owner is looking to structure the most advantageous deal that they can for themselves.
No, that's interesting. I would think that especially in the hard money stuff, where usually those are interest-only loans, at least what I've seen, that would be the perfect opportunity for a self-directed IRA lender.
Yeah.
Yeah.
Yeah, you got it. That's really a home run. The hard money lending is incredible. It's clean, it's neat, it's simple, it's secured by real estate, and it's got really high returns. It's a really amazing opportunity for IRAs.
Got it. Got it. All right. So you've taken us through to the point where we've got a checkbook and we're lending or investing money inside the IRA. Is there a next step, or is that basically you're up, you're running, and congratulations?
Yeah, that's really all there is to it. Obviously, over the life of the investment and over the years, there are things that couldn't come up, that wouldn't come up if you restrict yourself to mutual funds. But that's definitely 99% of it. When next time you're going to want to be thinking about something is when you're talking about distributions. So say 70 years old, and you're thinking about tapping some of that money. So distributing it may be a little different than distributing from a regular IRA, because you've got real estate. So how do you distribute real estate? That's something that may look a little different. Obviously, if you sell the real estate and it turned into cash, so that's really easy. But say you don't want to sell the real estate, that could look a little different. But what we try to tell our clients and people that are considering this is there are certain things that they've got to know up front. They've got to know about the prohibited transactions. They've got to know about the potential for UDFI. They've got to know, what they can or can't do. And they can do almost everything other than the prohibited transactions. What's going to be down 40 years down the line, they should be aware of it, but there are so many what ifs along the way that it's difficult to plan up front.
Got it. Got it. Bernard, this has been highly informative, and I'm sure the listeners will greatly appreciate it. Where can the listeners go if they'd like to learn more and connect with you?
So the best place to start is 401kcheckbook.com. That's our website. That's www.401kcheckbook.com. I welcome a personal email to Bernard@resurefinancial.com. That's Bernard at RESURE financial.com. Or they can call us at 212-259-9302. That's 212-259-9302. At the website, we've got an incredible amount of information. Most of what we've discussed today is somewhere on the website and a whole lot more. It seems there are some things that we had been hoping to get to, which is the checkbook 401k, which is really, really crucial for people to be aware of at this time of the year. Unlike an IRA, the checkbook 401k has to be implemented before year end, and the benefits that are usually available, which is that $50,000 to $100,000 or more in tax deductions or Roth money, is compounded this year due to what's known as the 199 Cap A or qualified business income deduction that was introduced. Maybe in a subsequent event episode we can get to it, but they definitely should take a look at the checkbook 401k plans before year end. The IRAs can be done at any time. There's no deadline, but the 401ks have a deadline.
Got it. Bernard, we are going to, if you're able, we are going to do another one of these because I think that given the time of year and the topic, it's of great value to all the listeners. So we will schedule that and drill down through the balance of that tax information you mentioned there, if that works for you.
Yeah, that sounds great. I'd love to do it, and always eager and glad to share information.
All right. Well, Bernard, I want to say thanks for taking the time to talk today. I've learned a lot, and I look forward to doing it again.
Yes, likewise, Darren, thanks so much for having me, and thanks for all the listeners for taking the time to participate.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.